The US dollar is in a state of flux, leaving markets on edge as they eagerly await the Federal Reserve's next move. But here's where it gets intriguing. After a surprising dip in inflation data, all eyes are on the Fed to see if they'll slash interest rates again. And this is the part most people miss: the delicate balance between economic growth and inflation control. A surprising twist in inflation data. Recent data revealed that U.S. producer prices took an unexpected tumble in August, falling 0.1% month-on-month. This comes after a revised 0.7% jump in July, which was initially reported as a 0.9% surge. Economists had predicted a 0.3% rise, making this downturn all the more startling. On an annual basis, the Producer Price Index (PPI) rose 2.6%, missing the expected 3.3% gain. This softer-than-expected inflation has fueled speculation that the Fed will cut rates by 25 basis points later this month, with a 90% probability according to Fed Funds Futures. The Fed's dilemma: to cut or not to cut. Carl Shimada, chief market strategist at Corpay, notes that while the economy has slowed, it isn't showing signs of collapse and could even pick up in the coming months. Inflation pressures appear subdued, but there's an upside risk. A quarter-point rate cut remains the most likely scenario, though a half-point move isn't entirely off the table. This decision will hinge on upcoming data, particularly the Consumer Price Index, CPI, for August, set to be released on Thursday. A Reuters poll predicts a 0.3% monthly increase and a 2.9% year-on-year rise in headline CPI. Geopolitical tensions add to the mix. Meanwhile, global tensions are keeping investors on their toes. Israel's airstrike targeting Hamas leaders in Qatar and Poland's downing of drones in its airspace during a Russian attack on Ukraine have heightened uncertainty. The euro climbed 0.3% against the Polish zloty, marking its largest daily gain since August 11th. The dollar index, which tracks the greenback against 6 major currencies, dipped slightly to 97.74, continuing its 10% decline this year, amid concerns over U.S. trade policy and the Federal Reserve's independence. Controversial question: is the Fed's independence at risk? Speaking of the Fed, a recent court ruling temporarily blocked President Donald Trump from removing Fed Governor Lisa Cook, a case likely headed to the Supreme Court. This raises a provocative question: how vulnerable is the Fed's independence to political interference? And what does this mean for the stability of U.S. monetary policy? Job growth concerns and market reactions. Adding to the economic puzzle, revised data showed the U.S. created 911,000 fewer jobs than previously estimated in the 12 months through March. This suggests job growth was already slowing before Trump's tariffs on imports. Markets, however, showed little reaction to these revelations, keeping U.S. rate expectations steady. For now, what's next? As we await the CPI data and the Fed's decision, one thing is clear: the economic landscape is more uncertain than ever. Will the Fed cut rates, and if so, by how much? And how will geopolitical tensions and domestic policy challenges shape the dollar's future? These questions are sparking debates among economists and investors alike. What's your take? Do you think the Fed should proceed with caution, or is a bold rate cut warranted? Share your thoughts in the comments. Let's keep the conversation going.